Hi, this is Jens Torsen of the Hartman Group. Thank you for joining me to review a Hartman program on actuarial value. Our objective today is to provide you with some general information around actuarial value, and the agenda will address the following questions. What is an actuary? What is actuarial science? What is actuarial value in the Affordable Care Act and the purposes of it? What are these metallic plans we hear about, references and resources, and always key takeaways that we suggest. Please keep in mind that our intent is to provide some baseline education, and any need for tax or legal advice should always be received from the appropriate counsel. So, just as a matter of curiosity, I Googled the question of who was the first actuary to get some context, and some images came up. Some of the guy on the left, Edmund Halley, Halley's Comet from 1693, as well as this mathematician, Christian Huygens, from the Netherlands, who studied probability theory also in that century. The consensus appears, though, to be that the first actuary was Jim Dodson of the Equitable in 18th century. No photo available. So what do these folks do? Per the Society of Actuaries, an actuary is a business professional who analyzes financial consequences of risk using math, statistics, and financial theory. In health insurance, they make efforts to estimate costs of health plans as well as create appropriate pricing models. So what is actuarial value? Per the Centers for Medicare and Medicaid Services, actuarial value is the anticipated covered medical spending for essential health benefit coverage paid by a health plan for a standard population, computed in accordance with the health plan's cost sharing and divided by the total anticipated allowed charges for essential health benefit coverage provided to a standard population. End quote. Well, that's a mouthful, right? Essentially, actuarial value is the cost of certain benefits, these essential health benefits, divided by allowed amounts of those types of claims. In this example, if 70% of all those charges are paid by the plan, this plan would be a 70% actuarial value. So tiers are created according to actuarial value. Per the Kaiser Foundation, there are three purposes for creating these tiers. First, to set minimum amounts of coverage people must have to be insured for purposes of the individual mandate. Secondly, to establish more general standards for plans. And finally, to benchmark premium and cost sharing subsidies provided to lower and middle income people buying their own health insurance. These levels are often described as metallic plans. And besides being differentiated by actuarial value amounts, for example, bronze plans have greater cost sharing to members than other metallic plans. Some are also used by policymakers in other ways. For example, bronze plans are used for group health insurance plans evaluation of payer play, as well as silver plans are used to create baselines for subsidy in regions, specifically the second lowest silver in a specific region. All right, so just generally some considerations actuaries, CMS, and insurers are dealing with around the application of actuarial value include definition of a standard population, definition of essential health benefits, and incorporating behavioral assumptions into the model. Finally, there are practical limitations of actuarial value. Per actuary.org, because premiums incorporate factors that are not incorporated into um, actuarial value calculations, premiums are not necessarily correlated with actuarial values. For example, the risk profile of the plan enrollees, admin cost, and profit margin all may make similar actuarial value plans cost substantially different amounts. So there are a lot of resources and references available out there. In particular, Kaiser Foundation, the International Foundation of Employee Benefit Plans, CMX, and various actuarial outlets all have great information out there. So our key takeaways that we would suggest: actuarial value plays a major role in the Affordable Care Act. The details matter quite a bit, but for most of the population, the impact is indirect. Direct impact is made mostly on policymakers, regulators, and insurers, though on an indirect basis, there are considerations for employers sponsoring group health insurance, such as minimum value requirements, and those should be reviewed with appropriate resources, such as your benefit consultant. We at Hartman take great pride in working within our team to stay at the forefront of the changes in our industry and distill the complicated and verbose information into specific instruction and strategy. And if you have any questions about this or anything else with respect to healthcare reform, insurance, employee benefits, please let us know. And thank you again for your time.